Hello and welcome to this week's US Stock Market Report. I'm Dale Gillham, the Chief Analyst here at Wealth Within. This week I'll be discussing cashing in on rare earth resources, and then I'll dive into the Dow Jones and this week's stocks of interest. Now before we jump into the report, I'd just like to mention that if you have any thoughts on investing or trading for that matter, please comment below and remember to subscribe to our channel to keep up to date with our new content. So let's get into this week's report. Unless you've had your head in the sand, you would have heard the common belief that rare earth stocks could be the next best thing that could make you a lot of money. But is it the next best thing? It's always interesting to me that the most uneducated in the market continually try to pick the next best thing. What they do not realise is that there is a whole lot more to selecting whether investment will be the next big thing and viable in the long term, or just a dog investment. Recently, there's been a discussion about the battle for rare earth resources between the tech giants such as Apple, Samsung and Google. The three big players have been attempting to purchase resources such as lithium, which is used in phone batteries, directly from suppliers. Now, due to the size of these organisations, their capital resources and economies of scale that they have, it is much more viable for them to purchase directly from the mines to reduce the overall cost of production. Now, a study conducted by researchers at Yale University shows that materials such as zinc, copper and aluminium are in no danger of depletion. Other rare earth materials used in the current smartphone technology, however, are at a real risk of scarcity. This means that it will become harder to source these rare materials in the future. Now, you might be all rubbing your hands together thinking that a diminishing resource means increasingly higher prices for the resource. Well, not necessarily. You see, humans are very adaptive, and when a natural resource starts to become expensive and no longer cost effective, we seek alternatives that are cheaper. Think of lead, which used to be used in pencils. Lead was expensive and unsafe for use, so now we use graphite. With the amount of smartphones being manufactured globally expected to continue to rise, the opportunity to buy and hold these rare earth materials has become quite elusive for some investors. Materials such as chromium, which is limited due to supply restrictions, mercury, which is limited due to the environmental implications of just mining it, gallium, where it's limited supplies, and cobalt, which is limited due to the instability in the Congo. These are some of the key resources that are used in the production of batteries and circuit boards, and they have all caught the attention of market speculators who are purchasing these rare earth resources in hopes that their scarcity will result in increased prices. Now, this raises an important question. Should I invest into rare resources? Lithium and other metals involved in making batteries will most likely rise in price over the coming years, and so the share price of companies in this area should do well. I also believe rare earths will do well as they are also part of this new battery technology. So on a world scale, we will see expansion into these areas and more governments and companies profiting from them. However, that being said, trying to pick the next big winner in the market may mean investors introduce high risk into their portfolios, and often speculators buying these types of shares are ill prepared to handle the risk and the huge swings in the stock price. A general rule I teach traders is that no more than 10% of the total portfolio should be invested in speculative investments. Savvy investors are sometimes willing to take on higher risk to profit from the increased amount of opportunities to buy commodities such as these rare materials. Ultimately, you want to be investing into assets that are rising in value, not going down. You need to be cautious as these emerging stocks are often at the low end of the liquidity spectrum, and that means that investors may not necessarily be able to exit at a price that they would like. They often rise and fall quickly and heavily, and so you will need to be prepared for a wild ride. Now lastly, many go broke and are delisted before they have a chance to take off. This risk to your portfolio must be managed regardless of how much is invested. In short, I always recommend that investors need to consider all the investments in the same manner with the same tight scrutiny, even if they're putting in less capital than they would for the more speculative stocks. So let's get into this week's stocks.
Okay, let's have a look at these charts on the screen right now. On the left, you've got a monthly bar chart of the Dow Jones, and on the right, you've got a weekly. But I want to have a look at the monthly chart first. It's quite interesting. I was actually saw Robert Kiyosaki on the TV yesterday, I think yesterday morning, and he was talking about the biggest crash, and he's been talking about it for a little while, and he really is more talking about, well, I believe he's more talking about the US market, because the US market doesn't tend to, how do I say it? If we don't learn from our past, we'll repeat it. And we saw a huge meltdown with the GFC, with the Dow, and obviously a lot, and the S&P, and lots of stocks in the US. And yet here we are. That's the high of the GFC, where my pointer is right now. If you look at that, October 2017, so that's 14,198. Now, if I go and have a look, find my nice little tool here, and we click on that, we can see here how the Dow currently is 81% higher, and has been up as high as 87% higher than what it was 10 years ago. So whilst it's not a spectacular rise, I mean, obviously doubling in price over 10 years means roughly about a 7.2% gain, roughly, in the rule of 72. So, but it has been rising very, very strongly compared to other world markets. Now, interesting, it's what's happening at the moment. As you can see how the angle that it was trading on through here. Now, if I use my little trend line tool, and we just go, just look at that angle, then we drag this angle, and you can see here, if I put it on that point, how fast it's going compared to what it was going. And as we know, things that rise fast, and if I put it through over here, you can see here, that sort of angle happened before the run down into 2003 or 2002 low. And if we look at here, just before the GFC, that sort of angle happened just before the GFC. As I say, the market runs in momentum, and what that means is time and price. So how is it unfolding? How many points is it unfolding per day that the market's trading? Is it 1 point per day, 5 points a day, 50 points a day? And looking at those sorts of momentum and volatility, you can determine how a market's going to unfold and whether it will fold over or not. Now, right now, the market is, or the Dow is running quite hard, although it did have a little bit of a pullback for a couple of months down into this low in April. It is moving up strongly again. So to me, whilst I'm not really worried from a world perspective, in terms of other world markets, that sort of stuff, is the Dow is due for a bit of a pullback, and it'll probably be in the order of 25-30%. But if you click on these sorts of tools and have a look at how far it might fall, you've got to be looking at this point in time. If it does start to fall over, it's going to go between 20,000 or 21,000 and 22,320. So that's where it would fall to. So it's not going to be a dramatic fall, but at this point in time, we have had a low in 2008. Now, Robert Kiyosaki did say we have lows every 10 years. Not necessarily, I wouldn't necessarily agree with that. It's very fuzzy. It's sort of 9, 11 years. It's not necessarily 10 years. Like, we did have a low in March 2009. There's no reason why we couldn't have a low in March 2019, a fall down into 2019 from that point of view 10 years later. But it's one of those fuzzy things. It could be a little bit earlier, it could be a little bit later. Time is not something that it's 100% accurate, like black and white, like a science. Let's have a little quick look at the weekly chart before I get into some stocks that are reporting at this point in time. Now, you remember I was talking about this as possibly being more of a bearish signal, this whole little pattern, and I thought it would drop out at the bottom of that, and it did, but it didn't keep going. Instead, it decided to turn around. So we had 1, 2, 3, 4, 5, 6 weeks up, 7 weeks up to the high of last week, being the Friday the 17th of August, where it hit a high of 25,728. Yes, it did, and it closed at 25,669. So this augurs that it's probably going to move up through into this level. If it starts faltering around this 25,798 level and starts to fall away, then we may start seeing it tip over. But at this point in time, the angle's not quite as steep as what it was moving up into that high. But as you saw on the monthly chart, and why I keep saying you need to go and look at the monthly chart, you need to look at the big roadmap, not the shorter time frames to determine direction. At this point in time, I have no reason to believe that the Dow won't continue to keep moving up, but I'm always being cautious of it, and that's really what I want to say. I'm being quite cautious of it. To this date, I want to have a look at a couple of stocks that are reporting. Here, most of them, I believe, are retail stocks. For some reason, I keep clicking on something and that sort of stuff pops out at the side there. But the first one I want to look at is Medtronic, and it's looking really, really nice. It's moved up from that low in 2009 to a high, come back down into another low into 2011. That is beautiful run up. And just consolidated a little bit. So at this point in time, it's now making a new all-time high. And if I go and bring it up here, you can see how beautiful this little run has been for this stock. So it's now making new all-time highs after this bit of a consolidation period. So I think there's a nice little run through here, and I think we could actually see this stock run through $100, probably up even to 120, 130 at this point in time. But it is looking nice. These stocks are all reporting this coming week in the US. So have a look. If you're not in this stock, this might be a nice little place to buy the stock because it has broken through this resistance. Might be a nice little trade of 10 to 30%-ish if you do all right. Lowe's companies. Now look at this one. This is again a nice looking stock again. So it moved up again and back down into a low, just like MDT. Moved up, but it went vertical for a while. This is what I was talking about a while. It sort of went really vertical, and then it's come back to that sort of angle again. It is looking quite nice. I think this stock will continue to move up at this point in time because it is making new all-time highs, but you can see how vertical this is in terms of that. I don't know how much longer it will run at this speed, but it is looking bullish still at this stage because if I use my trendline tool and click on that, you can see here how for a while there that was sort of the angle, and if we look there's a bit of the angle there. So it's running a bit harder in this times, but how long it can do that? I think it's going to blow through the $110. It might move up to $121.30. But this size, it's looking all right, so I would expect some good reporting from it. Let's move to Target now. What people may not know in the US is Target was founded in Australia, and it's become a very big company in the US, but it's actually founded. I don't know why that keeps popping out, guys, so please apologise for that. It is a very big company, and it was a retail company, retail stores, obviously. Target's become really, really good. It's looking quite interesting at the moment. It's coming up to that previous all-time high that it set way back here in July 2015, in that sort of area there, and moving up there. So expect some sort of resistance at this point in time. So here's that all-time high. Let me put my pointer on it. June 2015, 85.81. So looking at this, it looks right now. It looks strong enough for me to blow right through that. But you can see how that angle, what I've been talking about, it is actually following that angle. So if I use my trendline tool, and we just throw that sort of thing through there, you can see how it runs up and around. It keeps running back up, below it, back up to it, throw it back down. So it's running through there. So my expectation is this will be quite bullish. And I think it's got some good legs in this. I think we should see it blow through $100 in the not too distant future. So if you haven't seen Target, have a good look at it because it might be one to put into your portfolio. The next one I've got is Alibaba. Now it's a quite often talked about stock. Obviously, Jack Ma with Alibaba is a bit of an interesting person from that point of view, and it is a big online retail, and just like that, we've seen this huge big move straight through from January 2017 right through to January 2018, more than doubling in price. So that you would think it was going to take a bit of a breather, and it has done that. You can see how this is the highest close, which January 2018, the highest close the stocks had was $204. Currently, it is looking bearish. Now, this low here at 165.39, lower than that one, and just a tad higher than December 2017. So it'll be interesting to see if it can hold above that 164. If it can't hold above 164, then please expect further downfalls, and you're probably looking at it falling into the realms of that $148, $149 if it does blow through that one. So it's just finding some support at that 163. 68 or that 38.2% retracement of that range that I've drawn. So it's probably likely to go a bit further down. As I said, right now it is looking bearish. Even looking at the weekly chart, it is looking, let me get go zoom over there, you can see it does look quite bearish on that weekly chart. So sit back and relax. If you're not in it, sit back and relax, wait for a while, and then you'll get a much better entry at a much cheaper price. If you do own this, then I'd be looking at whether I would continue to hold this stock. So that's it for me for this week for our US stock market report. If you've got any stocks that you'd like me to look at, whether they're in your portfolio or not, I'm really happy to do that. So just shoot an email through to info@wealthwithin.com.au. I'm really happy to do that. My book comes out in the US. My book Accelerate the Wealth comes out in the US on the 9th of October. So look out for that one. If you're in the US, it's the US version. It covers all the 30 stocks in the Dow, and I trade those and show you how to do portfolio construction. Because to me, managing a great portfolio, making money on the market, has very little to do with the stocks just finding stocks. It's about the process you take. If you don't have a good process, you're not going to be a very good investor or trader, because you're going to be quite hit and miss. So let's start tidying that up and looking at that and getting into that. If you look at my book or you read my book, Accelerate Your Wealth, I'll teach you how to do portfolio construction. I'll teach you how to find stocks, and do it for yourself, because nobody ever rings me when a stock's going up. They always ring when the stock's going down. That tells me when they're ringing and they're worried about a stock, it means they don't have a process and a structure and a strategy. So do yourself a favour and have a really good understanding of how to buy, how to sell, and how to manage your portfolio, and you will do much better. So that's it for me for this week. Good luck, good trading, and I'll talk to you next time. Bye.
What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on SoundCloud and on our website. Now they're jam-packed with valuable information which will help you elevate your trading. Now if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.